All right, let's break down the latest earnings call from Bank7 Corp. Now, on the surface, this was a really solid quarter, but if you listen closely to what management was saying, well, you start to see some storm clouds gathering on the horizon. So let's get into it. First things first, the headline number. Boom. A 6.7% beat on earnings per share. That's a big number that definitely gets your attention. It's a strong start for sure, but as you're about to see, the story is way more complicated than just one number. So let's grade their performance for the quarter. Honestly, looking at the numbers, Bank7 pretty much delivered exactly what you'd want to see. A clean beat on both the top and bottom lines. And here are the receipts. They came in with GAAP earnings per share of $1.12. The street was only looking for $1.05. And revenue? Yeah, they squeaked by the estimates there too. You really can't argue with it. This is just clean, solid execution. Now, this right here, this is a measure of just how profitable they are. An 18.5% return on average equity. That is absolutely top tier. I mean, think about it. In a tough banking environment, pulling off returns like this, it really speaks volumes about their business model. So, how did they pull it off? Where did these great results actually come from? Well, the whole story really starts with the balance sheet. This is the engine room of the bank, and believe me, it was firing on all cylinders last year. Just look at their loan book, up over 12% year over year. In this economy, that kind of growth is, well, it's pretty outstanding. It tells you they are out there actively taking market share from their competitors. And you know what's even better? They're funding that growth the right way. Deposit growth of 7%. This shows you they have a really stable, loyal customer base, providing the cash. This isn't just hot money that's going to disappear tomorrow. These are real, sticky relationships. So when you put it all together, what do you get? You get a picture of a bank that is just flawlessly executing its game plan. They're a classic community bank, and they're absolutely crushing it in their home turf of Texas and Oklahoma, but just focusing on those core customer relationships. Okay, but here's where the story takes a turn. The earnings call wasn't just a big party. Once you get past the prepared remarks and into the Q&A, you start to hear a much, much more cautious tone from management. And this was the first big red flag. Right after posting these amazing growth numbers, what does management do? They immediately start tamping down expectations for the year ahead. If you're an investor trying to model out their future, that's a huge warning shot across the bow. And they told us exactly why they're so cautious. The competition is getting fierce out there, and that's putting a ton of pressure on the price or the interest rate they can charge on new loans. That's a direct threat to their net interest margin, their NIM, which is basically the lifeblood of a bank's profitability. This slide really says it all, doesn't it? It captures the core conflict for Bank7 right now. You've got this growth engine that's just humming along, but at the same time, you've got this intense pricing pressure that's hitting the brakes and threatening to squeeze their profits. So, if their normal organic growth is about to slow down, what's plan B? Well, management gave us a pretty massive clue. They're out there scouring the countryside for a company to buy. That tells you an acquisition might be the next big move to keep the growth story going. Okay, so let's put it all together. We've got amazing results in the rearview mirror, but a whole lot of caution and uncertainty about the road ahead. So what's our take? How should you think about this as an investor? This is the million-dollar question, right? After a report that's so mixed, which story wins out? Do you bet on the proven execution, or do you worry about the headwinds that management is so clearly pointing to? The stock chart actually tells the story pretty well. It's basically been dead flat for a year. The market isn't really punishing them, but it's not rewarding them either. It feels like everyone is in wait-and-see mode, pricing in both the good and the bad. And that's exactly why our official rating on the stock is market perform. We think the stock is probably going to trade right in line with its peers, at least until we get a clearer picture of where those profit margins are headed. And here's why in a nutshell. The pros are obvious. This company is a best-in-class operator with incredible returns. But the cons are just as clear, because management themselves told us that margins are under pressure and growth is going to be tough to replicate. It's just a perfectly balanced, but tricky situation. All right, now for the fun part. Let's put on our hedge fund hat for a second and cook up a trade idea based on everything we've just talked about. It's a little out there, but it's definitely plausible. Okay, here it is. The trade is to go long Bank7 stock while at the same time shorting the KRE, which is a big ETF full of other regional banks. See what we're doing here? You're not just betting the market goes up. You're betting that Bank 7 is going to be a winner relative to all its peers, no matter what the overall market does. So why do this? Well, first, it's a bet on quality. You're saying this premium operator will hold up better than the rest. Second, if they do go out and make that big acquisition we talked about, you're positioned to benefit. And finally, that short position on the ETF, that's your insurance policy against any sector-wide problems, like all this uncertainty around interest rates. And of course, we have to say it, this is not financial advice. All investments involve risk, and you can lose money.